Hey, what's going on? Thanks for tuning into the Wealth Accelerator channel. It's Hunter Lowry here, and my goal is to help you to create a family legacy, not just short-term wealth. So if you like these videos, make sure to go check out the Wealth Accelerator podcast also. You can find it on any podcasting platform that you listen to as well. So I've been going through my semi-annual reviews I do with all my clients, and I wanted to share some of the information that I've been giving to everybody and what I have been covering. There are two concerns that I have going forward that I believe is going to create some volatility, and I just want you guys to be aware about it. Now, before we get into this, I want to preface by saying I do not think it's time to sell the farm and bury cash in the backyard in your secret spot. I also do not want you to be chasing headlines as news comes out about either of these two topics. Don't worry and don't make huge, drastic changes. That is never a good plan. However, I will say these two things that I'm going to talk about, they do need to be addressed and they need to be thought about as you plan for your investments going forward. So the first thing to keep an eye on is the new Delta variant of coronavirus. With what I'm reading and with the research that I'm doing, I've been finding that the Delta variant is making up about a quarter of the cases in the US, which is expected to rise. So these are the questions that are now being asked. Does the vaccine that you might have recently received actually protect against the Delta variant? Do you need to get another vaccine to cover the new variant? Do you need to mix and match vaccines? I mean, I've been seeing headlines that you will be targeted by this new variant if you have not been vaccinated. It's going to come out and hunt you down. And regardless of political or social thoughts on all this, I just want to look at it from strictly an investment standpoint. 12 to 14 months ago, I was really big on travel and leisure. Hotels, airlines, cruise lines, all the reopening plays, as we called them. And these plays have done very well for myself and for my clients. However, I believe that some of these reopening plays may take short-term hits going forward. I think that news could spread and continue to pop up that this new variant is getting more and more people sick. I think it can scare investors and that these reopening sectors may see a short-term pullback. So for myself and for my clients, I'm beginning to lock in some gains with these positions. I would not be surprised at all if we got a mini deja vu with the travel and leisure investments like we had at the beginning of last year. Now, just remember, this is not a massive portion of money for any client. I'm not timing anything here. This isn't something that's going to happen in a day or a week, but it is never a bad thing to lock in some gains, sit on a little bit more cash than normal for the short term, and reallocate these funds into new sectors and just overall rebalance the account. So that is the first thing that I'm keeping an eye on. The second thing that I'm also currently watching closely is the whole talk of transitory inflation. And I'm sure you've been hearing this term a lot lately, especially if you've been watching the market at all. Everybody's talking about it. And basically, the question is not, is inflation here? The question is inflation here to stay? We all know that inflation is when prices rise, and we all know that this is true. A loaf of bread costs more than it did 40 years ago. But that's okay. That's healthy. What we have to figure out in order to determine if inflation should be a concern or not is what is the root cause and is it happening too aggressively? Now, there is no denying that inflation has been taking place in a very aggressive fashion lately. We're all seeing crazy gas prices. Lumber has recently dipped, but a few months ago, the price of lumber was through the roof. Remodeling your home was going to cost you an arm and a leg. Home prices skyrocketing. I mean, rapid inflation is all around us. It doesn't take any crazy math or a secret formula to see it. It's right there. So what is causing this rapid inflation, and is it here to stay? Some people, they think that prices are increasing so drastically because supply and demand curves are out of equilibrium. And I do agree that this does play a part. There are supply shortages all around us as well. It's pretty hard to buy a car right now. There's lots of chip shortages. If you want to buy a horse trailer here in Northern California, you're looking to wait a year more. Businesses, they can't get people to come to work. There's help wanted signs everywhere. Every business owner I've spoken with is struggling to hire and fill positions. So this is obviously a problem. We're obviously seeing a supply chain issue and we're not able to keep up with all the pent-up demand. But in my mind, this is not the main reason why we're seeing prices rise in such an aggressive manner. Really, the main issue, it comes down to the money supply and the Fed printing too much money. It's a direct result of too much money chasing too few goods. And if you didn't know this, from February of last year until now, July of 2021, the Fed has increased the money supply by 30%. That means that there's 30% more money flowing through the economy than there was last year. So, okay, what exactly does that mean and what does that have to do with inflation? Well, let's say that there are currently $10 in our economy and there are also 10 golf clubs for sale. Then each golf club is going to cost $1. So now let's say the Fed increases the amount of money in the economy by 30%, meaning we now have $13 that's available circling through the economy, and we still only have 10 golf clubs. At that point, each golf club is now going to cost $1.30. So there's your price increase automatically. Now let's add this into the equation. We experience a pandemic and supply chains are hurt. It's now hard to hire people. There are chip shortages, all the things that we already mentioned. So now, as a result of this, we only have 5 golf clubs being made instead of the 10, but the money supply was still increased. We still have $13 outstanding in the economy, but now instead of 10 golf clubs being produced, we only have 5 golf clubs that are available to buy. Now, each golf club costs $2.60. Obviously, this lowered output and the supply chain issue, that's not going to last forever. And that's why I believe it's only a portion of the problem, not the main factor and the main cause of the rapid inflation that we're seeing. We will return to producing a normal amount of goods that can keep up with the demand and reach an equilibrium again. So that giant increase in prices, that insane spike we've seen with some goods, I believe that part is transitory. Going from $1 a golf club to $2.60, that's the transitory part, I believe. However, there is still a long-term inflation effect that I believe is going to cause some unsteadiness. Because even when supply chains return to normal and we're able to produce the normal metaphorical 10 golf clubs again, the money supply still has not changed. So each golf club is still $1.30 instead of the original $1. And that's the issue that I see going forward. Now, without looking back in history, we have no way of comparing how large a 30% increase even is and what even happened last time the money supply was increased so quickly. So this is a great question because there is never anybody screaming at us, telling us to sell out and telling us the market's going to pull back. There's no flashing warning signs that come down from the skies to signal us to sell everything. All we can do is make good, educated decisions and set up our portfolios to get through any storm. So looking back in history, the last time that we came close to increasing the money supply as much as we did last year was during the time frame of 1943 to 1945. Now, this was obviously a much different time. There was no pandemic, but rather a pretty big war going on. It was right during World War II. So what happened to the economy during this window when the Fed was pumping money into our economy? During 1943 to 1945, the S&P returned 19, 13, and 30% respectively during those 3 years. Remember, this was the time when the percentage increase in the money supply was high and inflation was low. Okay, then let's move forward into 1946 and 1947. Now, the percentage increase in money supply is low and inflation is high. During this time period, the market lost 12% in 1946 and was basically flat, losing less than a percentage during the next 2 years. This was one of the most similar situations that I could find in history. Again, only speaking from an inflationary and monetary policy standpoint. I am not at all saying that now after this year, we'll see 2 years of negative returns. I'm not saying that one bit. I'm not saying to be afraid and to sell everything. But I am saying that this is something that's important to consider and to keep an eye on as you manage your investments going forward. Because if you have a good game plan, if you have buffers set in place to help manage what's thrown at you, and you understand how you're invested to reach your goal, whatever that may be, then you don't have to run to your computer and refresh your Fidelity app on your phone when an intimidating headline pops up, and you won't be making short-term quick decisions that could hurt you in the long run. So if you would like any help going over your financial goals and making sure your investments and overall financial position is set up in a way to help you reach those goals, then you can go to my personal calendar at hunterlowry.com and you can schedule a free call with me. I would love to talk with you and help you out. Thanks so much for watching. Have a great day.